Faraz, first one here. Very nice. His last name is Kermani? I didn't know that. I just thought it was that Persian dude. Faraz Persian dude. Okay, going live on TikTok. All right, live on TikTok. Wow, we've got 4 people tonight. Oh, that's really great. Oh, there we go. Hey, Keith and Faraz. I wonder if I'm going to convert Faraz tonight on something about options. We'll see. I'm going to talk about options a bit. And I think I might just have a faithful conversion happen tonight. Oh. All right, everybody, welcome. I don't know what it's about Tuesday night or something, but I'm still waiting for a bunch of you to come in. We had a Tuesday night thing or something. Oh, thanks. I was like, there's no way she's making me a margarita right now. And she was. That's my good wife. Oh, nice. I was like, I'm hearing her blending ice and doing something with ice. She's making margaritas without me. No way. Oh, God, yeah. That's perfect. Faraz. Here's to you, Faraz. Oh, that's just perfect. Oh, man. Oh, I just can't wait to be having those every day during the summer. 50% gains in one day? Fucking what? No way, Alex. Okay, but just FYI, you risked way too much money. Alex. Yeah, man. Alex, on Thursday night, just for the VIP, we're going to have a private class for everybody in VIP. Hopefully you are in our VIP. And I'm going to talk probably, it might be a 2-hour class. So everybody put that on your calendar, by the way. Thursday night. But I'm going to talk a lot about risk management and more like account management and portfolio management. But we'll probably work our way back. Well, probably start with like, okay, your job and your savings account, right? And we'll work our way all the way up to just like maybe even trade management by the end of the class. So VIP class on Thursday night is probably going to be pretty useful for so many of you. I'm going to send out one more announcement. Hang on, guys. Sometimes when I send the announcement right before 8, I don't know, people don't believe it, or I just get unlucky, and we get much more people showing up when I send one after 8. Let's see what happens. Faraz is listening. All right. Cheers, Faraz. Cool. Yeah. Sure. Any thoughts on how the Coinbase IPO? We can talk about how to trade the coin tomorrow. We're going to trade that live. Tomorrow's live trading all day, you guys, on TikTok. So make sure you join my group tonight. It's free live day trading all day tomorrow in my group, Wednesday. So click the link in my bio. Come on through. You can even like come through right now and jump right into our Zoom. You can come right in right now. Come right into our Discord for free. Come right in, join the Zoom, and you'll be with me full screen in 4K right now. So tomorrow, yeah, we'll be trading the coin IPO, and under my direction, I will do what I can to tell you how I'm trading it, and you guys can follow along and see how you guys do as well. Where do I trade? In my trading group on Discord. So click the link in my bio, either at the end of this or just follow me now, and then like a little bit later, whatever, click the link in my bio. Come on through. All right, so today we had yet another green day on SPY, and it just can't continue like this for much longer, can it? I mean, wow, the insane run. It just keeps going and going. Now, if we look at SPY, the market, by the way, is SPY, S&P 500. If we look at it with like as a channel, let's start with a channel analysis. Here. Actually, I probably should do this with the lines in TradingView because they will be so much more flexible. So you can grab a parallel channel tool in TradingView, and what you want to do is you want to intersect as many tops as possible. You don't want to be an anal retentive dick trying to get like all the way to the end of the wick like this. You know, see how I'm doing that right here at the bottom. That's not the way it's going to work. And you don't want to be coming up to like maybe that one. You actually want to hit as many as reasonably appears to be darn near the normal, typical, predictable channel moving forward based on the information from the past. Okay, so I just laid that in real quick right there, and I'm actually pretty happy with it. I was gonna like be flexible with it, kind of move it around. I'm actually pretty happy with how I drew that. I think that's probably accurate. Okay, now here's the thing. Here's something you need to think about. So we've been loading up on puts. Because we're expecting some reversion soon. Every time that we move to the top end of the channel, that's like RSI. It's getting overbought. The whole market's getting way overbought. Everybody's holding shares and they're clenching, right? It's getting all bought up. And then what is it going to do? Well, some people are going to be like, well, it's not. We're not going anywhere. Let me have my money back. The weekend's coming up, whatever, and they start to sell, and that starts to keep things moving down, and it creates a feedback loop, and now everybody's selling, and it's because it's overbought and there's no more buyers and everyone's sitting. And so that's kind of like where we are now. We're overbought. But here's the thing, something to consider as you're maybe loading up on puts day after day, as we have been. We've been just loading up on puts every single day. Something to consider is that the price of SPY can still remain at the top end of this channel, right? Like here, let me project that out for you to give you an idea of what I'm trying to get at here. Okay, so if you think that the market can't go higher, well, the thing is, if it goes in just like very mild motion, it can kind of just keep doing this every day. And it can go higher, and it can keep going higher, and it can reduce your puts pain threshold to extreme mercy level. It could just keep doing that. It is possible. Okay, that is one possibility. The other possibility, let me get rid of those. The other possibility is we have an exhaustion candle form, and it's going to scare the crap out of you on the day it happens. You're going to be like, oh shit, that's it. I'm freaking out of these puts. Forget it. It's going to be something like this. This could happen. A huge candle. The thing is, when a candle happens like that at the end of a run, which is what it is, it isn't a great huge FOMO sign. Well, it is actually FOMO. That's it. That's the last. It's the end. Everyone, it's the FOMO group. It's like squeezing the very end of your toothpaste out. It's like nothing's going to be left. And after that, the next day, you'll probably start to see that reversion process start to happen. It may be a little bit bumpy and choppy along the way because that's just going to be the way the market's going to work its way out, work the price back out. So it might take 2, 3, even 4 weeks for it to reach the bottom end of that channel. So that's another way that could happen. We could get an exhaustion candle, a strong exhaustion candle. The other way that I talked about right before that was we don't get an exhaustion candle. We just get kind of this gentle, mild, we keep increasing on the market, whether it's a low volatility day or not. But here's another thing that could happen is tomorrow, that's it. Tomorrow, I mean, we're already down in after hours a little bit. Tomorrow, that's it. It falls underneath today's low tomorrow. At some point, it opens a little bit kind of in the middle, and then it tests the low of today, tomorrow. And then it will poke through a little bit if it does do that. So this is possibility number 3, right? And it will poke through, and that won't be a good sign. Breaking yesterday's low, breaking the previous candle's low in an uptrend erases and negates yesterday. So like, what do you think that does to everyone that got in yesterday? It freaks them out. You get stop losses start pounding, and then it's not that far before this next day's low would be broken. It's really close. I think it's like it might be 80 cents on SPY on the market, so it's really close. It's a high probability. Remember, these are three options that I'm showing you. Okay, so it's a high probability that if we were to break, if that were to happen, it could send a larger red candle could happen. Would that get all the way down to now 3 days back to that kind of low? I don't think so, because this overlap right here, this 4 day back candle overlaps the price action enough on the bottom of this 3rd day back candle that it will probably provide like a bit of a support zone. So if price were to drop, let's say tomorrow, below those lows, like I just said, it'll probably head down to 408 and then stop or bounce or whatever. So be aware of that. If that does happen tomorrow, that'll be cool that I've actually called that, right? And then Jesus Christ, you probably could call me the prophet or something, but but that's probably not going to happen, because the market is tricky, man. The market is tricky, and that's why you have to be ready for a range of options. Every trade is a probability spectrum. It's not an absolute thing. Every trade is a probability spectrum, and when you lose a trade, it's not because you did something wrong. It's because that was the probability of losing. It happened. Whatever the probability of losing was, happened. That's all. Nothing's 100%. So you'll never hear me say, "Oh, it's 100% absolute." No, you can never hear me say that. So anyway, those are the three probabilities really for SPY right now. But what I will say this, that there has been only 3 other times this year, in the last year, where we've done this. Actually, this hasn't even happened, where we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 green days in a row. And to be honest, though, if you actually look, this is a green day, and yet it's lower. So just because they're all green days doesn't mean they're all price improvements day over day. Some days the market opens low because it did really poorly the night before, opens low, and then goes up, and it didn't even get to where it was the previous day. And so that's actually, in my opinion, kind of a down day, but it can still paint green. So in any event, we had 13 days in a row which painted green. So there's a feeling going on in the market that you can't lose. The market's going up and up and up, and it's going to make it easier for investors to get in, and probably they're going to get trapped. But look, let's take a look back historically. How many times does a run like that happen in the last year? So we can use recent price action. So here's one right here, right? We had 1, 2, 3, 4, 5, 6, 7, 8, 9 candles to get to the top end of the channel. And then once it hit to the top end of the channel, it started to come down. And if you had gotten puts, you'd be like, "Oh yeah, this is it." But it actually didn't go lower than that previous day on that particular one. This one did. So you'd be like, "Yeah," but actually it took another 2 days. It actually went higher, even higher than it was before. And you've got to be saying, "My God, why didn't I take my profits 2 days ago?" And then the next day it gaps open even higher. And you got to be going, "That's it. I got to get out." And that's exactly what happens. The entire market starts to fall for the next 2 weeks. And you shouldn't have gotten out of your puts for sure. You should have bought more. The market just can't go up forever. Okay, it can't. It's just, that's the way it trades, because everyone's already getting their money all committed, and then there's no trading left. It has to give way. It has to give way. Okay, so but what I want you to learn here is that when it hit the top end of the channel, you had 1, 2, 3, 4, maybe even you might even want to call it 1, 2, 3, 4, 5 days of slamming the top end of the channel in a row. 5 in a row. And where are we right now? We're at like 3. So you need to be ready. You need to be prepared to take 2 more days of getting hit all over your body, right, on this. Okay, now let's go back and check another run up and see what it looked like. um, a natural run. This one was huge, really, really long. What I'm able to do is I have an average true range channel, which will effectively auto adapt this channel to the current kind of price movement. So I'm going to take that channel off so you can see what that looks like. It happens to be a way that I like to trade, and it is one of the more um, what's the word? Not mysterious, but elusively advanced ways that some very professional traders trade is they use this average true range channel. I really like it. Here's what it looks like. So what this is showing you is they're basically called volatility bands, but it's a little different than like Bollinger Bands. They're average true range bands, and it tells you based on a certain period, which in my case I think I have it set to 21. Yep. What is the first standard deviation, second standard deviation, and third standard deviation move for the stock price? And what does that mean in statistics? Well, the first standard deviation falls 67% of the time in the series. The second standard deviation, I forget. I think it's 92% or something like that. It's very, very high, 89%. So it's around 89%. Captures 89% of all the movement. The third standard deviation captures 99.7% of all possible moves. So what does that mean? It means that 99.7%. It means that movement occurs at the third standard deviation level only 0.003% of the time. So very rarely, 1 out of 333, 0.003%. 1 out of 333. And if there's 220 trading days in a year, or however many there are, 250, whatever it is, trading days in a year, then on a chart like this, you're only going to see in something like a touch of the third standard deviation very rarely, like once a year and a quarter, something like that, right? So if you notice this red band, which is at the top, that's the third standard deviation band. We're on it. We're touching it for 3 days in a row. Very rare, but where in the past has it done that? That time that it hit the top end of that channel that I drew 5 days in a row? No, it didn't. That was only the second standard deviation. So that wasn't even an extreme move. That wasn't that rare. We go back further. I gotta zoom up here, I guess, for you. We go back further, and even over here with this big, huge candle, we did not touch the third standard deviation. It was not that rare. We did, however, on one day in November, have a gap open that was massively up at the third standard deviation level. Guess what happens? Because it's so incredibly impossible to hold the third standard deviation level. Boom, it just came right on back all day. It's called mean reversion. Okay. So when you have price that typically is around a particular level, when it gets up to a standard deviation out or more, 2 standard deviations out, it has a high kind of gravity to come back and do what's called mean revert. So here's one. Here's something we can look at. Look at this. There was just this huge run. It finally got up to the third standard deviation channel, and it was just a huge blow off top. This was in September, and it was incredible. I think you probably remember it if you were trading the markets. Tech and stuff. Tech was really leading the way. Tech was going up, and we're like, wow, that couldn't be it. Then all of a sudden, whoa, just blasted off, and it was like, can it go more? Yes, and it could go more, and it even blasted off more until finally it got out. I mean, that was probably damn near a 4 standard deviation move. It had to be 1 in 5,000. Very rare, like 1, 2, 3, 4, 5. A very rare, huge run. So probably, like probability wise, we're not going to see that. We're not going to see that tomorrow and Friday. Tomorrow and Friday, we're probably going to see either that huge exhaustion candle, and then that's it. It's the end. Or we're going to see maybe 1, 2, 3 more days that are just tiny casual days hitting in a row, or that's it. That today was the highest we got, and it's going to start to come down after it's been 13 days in a row. Those are your choices, and so what I'm saying is it's the probability spectrum. I'm not going to say what it's going to be. No one can say, oh, this is what it's going to be. It's a probability spectrum, so just be prepared. But look, when things are at the top like that, they tend to come down eventually. So if you have enough capital to keep getting into puts and try and position yourself for that move, you have a high probability behind you. You have a high probability behind you. You can get wiped out by a very rare, extremely low probability event. It can happen. Those are called like black swan events. And like in this case, it could be that who knows? Maybe something wonderful happens in the economy. Some data comes out tomorrow or on Friday, and it was just inching along, and then some data comes out, and then man, it just sends like a catalyst. It sends it running for the next 3 months only up, and it's like you're gonna get wiped out. So don't put all your capital into a trade like this. Always max out your allocations to no more than like 5% of your portfolio. Unless you have a small portfolio, you can maybe do 10%. If you have like a $5,000 or less portfolio, maybe you could do 10% per allocation. But if you have a bigger portfolio, you don't want to be risking everything with black swan events lurking out there on these situations, because you don't want to go broke in your life. You want to be wise. Now, are there any questions on all of that? That's a market analysis. Is out of the money okay for this trade? Yeah, it could be. Yeah, I'm not doing it that way. But stick around, because just a little bit later in this segment, I'm literally going to show the difference between out of the money and in the money trading with calls. And I think it's going to blow your mind. And I'm hoping Faraz is going to be able to watch, because we just might have a convert who's very difficult to convert in this respect, and we'll see what happens. But all right, let me see what other questions I have. I think it's average true range. What's up? Yeah, this is the average true range channel, ATRC in TradingView. Average true range channel, ATRC, average true range channel in TradingView. All right. I'll come back to any kind of stock related. Any questions about the market? Any questions about this analysis of the market? You're in VIP. You will not be able to make it Thursday, but my evenings are usually busy. That's okay, man. I'll post it, or if I don't, it's just because I forgot. So just, write me a message and say, hey, man, I was one of the ones who couldn't make it last night. Can you post a link? You don't have to say like, hey, man, you forgot the link. But by the way, my feelings won't be hurt. You can't hurt my feelings. You can be a total dick to me. That's fine. And I'll still, post the link. Just, yo, fuckhead, how you didn't post the link last night? Post it, or are you going to be a twerp, and I'll still be like, hey, yeah, I'll get it. All right. Now, any questions about this market analysis here? It should not continue like this, says Alex. Yeah, I know. Top of the channel for SPY. Let's see, anything about this? Just keep buying puts or calls, depending where the channel, would that be an option? Right. I mean, yeah. I mean, right now, at the top end of the channel, you have to expect that eventually here, we're going to get some kind of a mean reversion. We're going to get a pullback down to the other end of that channel. So that's why each day I've been finding opportunities to buy a put. Like today, I bought a put at 413. I was going to buy another one at 414. I'll buy one there tomorrow if it hits there. 415, 416, 417, 418. I'll just keep buying. And also another time in which I will buy puts, I'll load up even more, is if price breaks the bottom end of any previous day like that. Because that's a bad sign. It erases the previous day's progress, which creates frustration for buyers, and they all sell, and that will create that pullback, that necessary pullback. Right. Yep. We're averaging your puts. Yes. However, I made the mistake, and it was just a mistake. when we first got into puts a couple days ago, made the mistake of buying this week's expiration. I meant to buy like 2 or 3 weeks worth, so I have lots of time. So anyway, today I started buying the next week's expiration. Should have did that from the get-go. All right, let me see if there's any other questions on that. How does this compare to last March's uptrend? Well, this has been 13 straight days in a row of going up, and in March we had it was pretty rocky, but the uptrend we got was only 1, 2, 3, 4, 5, 6, 7, 8 days long. Maybe you think 9 days long, 8 or 9 days long. So this is already 50% more stretched out than then, and I can't actually see on the chart going back any time period in which we've had 13 green days in a row like that. That's pretty rare. I'm just looking now. For years, that's a very rare event. So how this can't continue. Statistically speaking, it just can't continue. You know what I mean? So, but we say that, but you have to be ready to be wrong. So tomorrow, if we get 14 green days in a row, it becomes 14 green days in a row, but that just makes it even more likely that the 15th day is going to be red. So yeah, 13 might be the freaking record. Yeah. You might be right. Let me take a look on the internet right now. Most number of green days in a row on S&P 500. Historical win streaks. The win streak will extend to 9 days. The S&P has had 40 9-day winning streaks since 1928. One has to go all the way back to 1995 to find a streak of consecutive gains longer than 9 days. It has only happened 22 times since 1928. The longest streak ever was in April 1971 when the S&P 500 went 14 days in a row without sinking. That is also the only occurrence ever where the S&P 500 has closed up more than 12 days in a row. So that's pretty exciting, right? That just makes me feel like, I'll tell you what, I don't know if you guys, if that's the gambler in you or not, but that just makes me feel like going fucking all in. I'm ready, baby. Yeah. I'm going to liquidate more tomorrow. I'm going to get all, this is historic. Since 1971, we have not had 13 green days in a row. I am ready. I'm going to jump way on this now. That's how rare this event is. So already we've hit probably a 4th standard or maybe even 5th standard deviation event here. I mean, this is really rare. How does this compare to, okay, do you think all the stimulus increases the odds of this kind of a black swan event? I mean, we're already swimming in it, right? I mean, we haven't had this since 1971. We just realized 29 years plus 20 years. It's been 21 years. It's been, what is that? That's 50 years. It's been 50 years since we've ever seen 13 up days in a row. So I'm sure that the stimulus had something to do with that, for sure. How far out do your puts expire? I have a range of them. Mine expire on Friday, and then I have some more that it starts expiring next week. But you might want to get 3 weeks of time, frankly. And we're going to go over options in a minute here, and I'll show you why you might want to choose in the money options instead of out of the money options. But you could also get a mix of them. You could get a mix of them because expectation, just because the market may go down, might finally have a down day after 13 or 14 up days, doesn't mean that it's going to not continue and then for another 13 after that, right? Those statistics were not super clear, but actually they did say that it kind of like took a nosedive after that. But we don't know how far this is going to come back or when. And so therefore, I will show you why it is a very bad idea to do out of the money puts in that situation versus into the money puts. And maybe some of you with a little more experience with in the money versus out of the money can already have a notion of that. And maybe some of you who have been taking my classes. Alex is like, I've got $30,000 of cash laying around here. Well, Alex, I will say this. If you do that, do it in varying degrees. Always keep capital kind of like ready to correct your trade, average it in, whatever you have to do. And then the other thing I was gonna tell you is make sure it's in the money. So just don't go hog wild, because as they say, pigs get slaughtered. So be careful. It seems like anytime you go hog wild on something, it's exactly when you get freaking slaughtered, right? Have you ever noticed that? It just seems like it. So be very, very careful. You can make a lot of money by just putting, like, if you said you have a 40,000 portfolio, you can make a lot of money just by putting like $2, $3, $4, $5,000 on this. I don't even have that much on it right now. I have like $2,000 on this play so far, but I'm gonna start to put more now that I know that this is quite the historic event. It's got to come down. Compare the RSI to the past runs. Ben says it's crazy. Interesting how it's been a little lower volume. That is true. Yes. If I pull up the volume down here at the bottom, I got a couple other indicators here, but yeah, the last like 1, 2, 3, 4, 5, 6, 7 sessions, volume has been super weak. And today was also, again, one of the weakest. If it wasn't for just a little bit of up movement, it would have been the weakest of the last 13 days. Yes. What happened next? Okay. Last 2 quarters, earnings, a SPY was down. Okay. Bearish divergence. Okay, good. You see bearish divergence on the RSI. I just took the RSI off my indicators here like 3 days ago. So anyway, if you see bearish divergence on the RSI, good. Yeah, everything is nuts, says this guy. My house, what's your name, dude? Is up 100% over the last 5 years. Yeah, I live here in the middle of Texas, and last year we were going to buy a house, and it was like 350,000. Or the typical, let's just go. The typical house here is about 350,000 last year. That same house right now is worth like 650,000. So prices here almost doubled in 1 year. It's crazy real estate right now. Real estate's a whole other. I think we talked about that last night. I don't remember, or this morning. I think we talked about it this morning. Real estate's freaking crazy right now. Yeah, up on decreasing volume. Yep. I mean, all signs are leading in the same direction. So I probably will start loading up on more on puts, but I think I want to reserve some to sort of snowball into it. So like, as it keeps breaking each low, I'm going to double up or something. I'm just going to have some kind of I want a snowball on the other side of the mountain ready to go. Okay. I mean, we've got this side of the mountain, and I know we're at the top and we're not quite sure, how much more. When we get to one peak, is there going to be another peak behind it? Where's the top Everest kind of thing? But once we get to the very top, once we're there, I do know that I want to have enough energy. I want to have enough oxygen left over to start to actually propel me on the downfall, and I want to start to barrel into that, once the snowball starts happening. So that's another thing you have to consider. So, your version of going hog wild on something or going all in on something might be quite a bit different than the more risk managed version of my own going all in on something, right? So be careful. Don't be insane. Don't be ridiculous. Do something smart. Think ahead several steps. Okay. Be careful with your money. What if I wait for confirmation like that is actually going down before I buy? Yeah, man, Alex, you could do that. What I would say is that what you'd want to see is either price break the low of one of these previous days. Now you can start barreling in, like I'm talking about. Or the price may gap up, for example. Okay, gap up and then maybe push up a little bit, but then come back down and turn red on the day, meaning price is now below the open. That candle will be red. So we call that turning red on the day. But if it gapped up, went up, and then came back down and starts to turn red on the day, that's it. That's a huge sign that it's the end. That's a reversal candle. And if it touches the top of the previous day, it is very likely to start to retrace right on through that previous day's candle. So there's 2 situations there. What did I say? Going underneath the previous day. You might want to write these down. And then the second one is if it gaps up, pushes up a little bit, and then it starts to go red on the day, And then even worse, even better for you, if it touches the top of the previous day's candle, it fills that gap, okay, and starts retracing through the day. I mean, that's like, those are several really excellent things. And then finally, like I had said before, if there's just a huge, massive exhaustion candle that happens, like it's a FOMO, it's just the last of the last, it's everyone squeezing the last bits they have, everything they have goes into it, there'll be nothing left. It's like you trying to inhale, and then when your lungs are full, you got nothing more, and you try to do more, you can't, and there's nothing left except exhaling, right? So that's where we are in the market right now. And so if there's a huge exhaustion candle, you'll want to take the top of that candle. It could even be that the next day from that exhaustion candle, it gaps up and then continues up, but then that's the end. And then it comes down, bleeds red, and then it goes through the exhaustion candle, and it's a huge reversal. So we're here, it's within days, if not tomorrow, if not Friday. It's going to be interesting. I mean, it sure would make for an interesting market if something happened before the end of the week, wouldn't it? Yeah, I mean, we're already in it for a lot of puts, already, and I'm already getting FOMO. And I'm already in it. I mean, how many of you are getting FOMO about this and you're even already in it? You own puts, because, Kawane says it would be great if I just wake up tomorrow and it's already dropping. So I presume that you're probably already in it. And then Norm says, what if it gaps down in pre-market or at market open? How do we get in without chasing, without losing our shorts with a market order gone wrong? No, you don't. It won't be chasing. It won't be chasing. What I'm saying is if it breaks a previous day's low, you're good. And that's what a gap down would be. So you're already good. Okay. All right. Well, I suppose you mean like what happened here. Well, it needs to gap down below a previous day's low. So it would have to gap down below today's low. If it does that, then you're home free. It's already on its way. And, we who have puts already win even more. We get to rejoice. I've got a few, and I'm starting to think I should have gotten more. Well, fuck yeah, because this hasn't happened since April 1971. That's what we just learned. All right, so listen, I want to talk a little bit about out of the money versus in the money puts here. Options, actually, for example. I'm going to do this first from the perspective of calls, and then it's going to become apparent to you. All right, so I will draw this here. If you were to get an expiration, this doesn't exist, but let's say May 1st, that's this line right here. It says May on the bottom of my chart. If you were to get an expiration of May 1st, you have until that day with your option for the price to reach your strike that you choose, or you don't make any money. It's worthless. Okay? So let's say you think SPY is going to continue and you get out of the money calls, okay? Out of the money calls. Let's call it the 428 calls. That's this price right here, 428. That means that from the current price, when you buy it, boom, right then, that by expiration, price needs to be above this white line, 428, for you to break even, be worthless. In other words, if however much price is above this white line by expiration or along the way is your profit. If price goes below this white line, like SPY, if it goes below that white line, you lose everything. Okay? So I want you to understand that because I'm about to teach you something else. But let's say instead you got the in the money strike. By expiration, you're like, oh, well, if I'm going to lose everything, if I get the 428 by expiration, if it doesn't make it up there, I lose everything. If it doesn't even make it up there, what if it makes it up a little bit? Do I lose all my money then? Yeah, you do. You lose all your money. If you get the 428 and it doesn't make it above that, everything. You lost everything. You didn't make any money, zero. But you say to yourself, oh, okay, well, what if I got like the 392 strike down here? That's like way deep in the money, right? What that means is that by expiration, you'll lose all your money if price goes down there. You'll lose all your money. But remember, let's say we're not talking about the mean reversion situation before. I should have went to deer, so this is more clear. But the expectation in this bet, in this what's it called? In this pretend bet, is that this particular stock, whatever it is going to continue up. Okay, so follow me on that. All right, don't be retarded. All right. Now let's draw in green. Let's pretend that SPY now goes up and it does something like this. Okay, for many days, it goes like this. And even one day it gets your hopes up. Those people who bought the 428 strike, and you're at break even. You're like, yeah. And then, but then it comes down a little bit. It does this and even goes up more, and it ends up at 425. Okay. All right. Let's say that's what happened. So let's see what happened. The people who bought the 392 strike, they have more money than they started with, because it's way above where they started. And the break even was down here at 392. Okay, so they made like $1,000, because I think it went up about 10 points. Yeah, they made like $1,000 on their option. All right, and the option, maybe it cost $1,000. So let's say they doubled their money. That was the in the money strike, 392. How about the out of the money strike? Oh, those were only $50. So I loaded up. I got 20 of them. Right. So we have the one dude at the bottom who bought one option for $1,000. He doubled his money. He made $1,000. That's 100% return. Now you have the other dude who bought 20 $50 calls at the 428 strike because they thought this stock, this hypothetical stock, was going to go up. It did go up. Unfortunately, it just missed their strike by expiration, and then the whole way it stayed underneath their break even. By expiration, how much did they lose of that $1,000? Everything. Not a little bit. The whole thing. All of it. 100% total loss. And it was exactly the same amount of money. And the price of the stock did the exact same thing. It's just one dude bought 20 out of the money calls, and one dude bought one in the money call. And the dude that bought the one in the money call, let's say price went against him. Let's take our red one here. Let's give the dude that bought the in the money call a bad time. Oh man, instead price is doing this. Oh, here we go. I'm trying to paint a bad hypothetical now. Let's say the price does this on the guy that bought the out of the money calls. It goes kind of sideways and a little bit down, and it ends like right here at 408. Dude, the guy that bought that out of the money calls is like, he's been long gone. He's had no money for a long time. He has like $1 per option contract by expiration. Like, he's had no money. However, you have only lost, if you bought that in the money call, that one in the money call, you've only lost like 10% of your money. Like right here, this range right here, you've only lost like 15% of your money. So you lost like $150. So you have $850 left. So you only lost 15% in a bad situation. And in a good situation, you made $1,000. That's in the money strikes. Out of the money dude lost all of his money. He even bought 20 of them, and he didn't win anything. He lost all of it, 100% total loss, even when it did super well. The other guy, he lost everything. And the other guy made 100%. And this guy lost everything. Well, in the situation where it goes really bad, the guy that bought the in the money doesn't lose everything. He only loses a little bit. So you can see, I don't know if you can see, can you guys understand kind of like what I'm getting at here? The difference, the massive risk difference, how bad of shape you're putting yourself in when you buy out of the money options versus in the money options. You're in a race against time to try to get above your break-even line day by day by day, and you're likely gonna not make as much money had you put the exact same amount of money into an in the money strike. Any questions? Let's get some questions. What happens if it actually makes it to the out of the money strike? Well, let's say that's a good question. Let's say there's a much rare event, which would you got to realize though that you've put yourself in a difficult scenario, right? So But let's say it's this. Let's say this happens. Price of it continues, and it's like, wow, it's just amazing, right? It's $4 above your strike of 428. So you had like a 99% chance of losing all of your money, and maybe that's the way you love to gamble with $1,000. But you had a 1% chance, a very rare percent chance of now making of your contracts now being $400 per contract. So times 2,000 shares, now you have $8,000. If that attracts you, if you say, "Oh fuck, I'm doing that. Yeah, fuck that. I'd rather have a 99% chance of losing all my $1,000 and a 1% chance of making 8,000 than a 85% chance of only losing 15% of my money and like a 60% chance of doubling my money." Like really? Like, okay, come on. So yeah, no, I mean, Coane, your question doesn't matter, because the point is, when you choose out of the money, your chances of making money are so far lower. It doesn't matter how much money you make. It's the chances that you're going to make money are so much lower. So it doesn't really matter, right? But if you could get an in the money strike, your chances of making money are almost, your chances of having money by expiration is almost inevitable. It's super high, like 85 to 95% chance. And your chance of making money is way high as well compared to the other money. So do you understand that? Okay, so your question is, what if you can't afford in the money? I mean, seriously, you should start thinking about this. You probably shouldn't be trading, because that's not enough money. Like $500 or like $2,000 is only enough money to lose. So okay, but there is a little bit of a trick around that, which is that you could get a vertical. You could get a vertical in the money. So you go down there and you get the in the money, like the 392 in this situation, but you get a vertical, and you have to have options level 3 in order to do that. But in order to do that, you have to have an account that has margin. And in order to have an account that has margin, you have to have a minimum in there, I think, of $2,000. So, yeah, the odds are kind of stacked against you. It's bullshit. I know. It's like the less money you have, the less help they give you, the more restrictions and constraints they put on you, and the more probable it is that you're going to be led into a fuck up situation, right? So it really is lame. But if you have more than $2,000 in a margin account with options level 3, that's one thing you could do. Is plan number B is you could get a vertical in the money. But can I get some kind of an acknowledgement as to how many people now understand kind of the quality difference, the danger difference, the risk difference between getting an out of the money and getting an in the money option? And how do you feel about it? Can you say something? Thank you. Yeah, Norm says 100% understand. Camille says I got it. John says yes. Swing on the Spiral says yes, definitely makes it even more clear. Dan says, oh yeah, I had no idea before. Now I see why I lose all the time. Awesome. I mean, it's awesome that you now know that. Paul says yes, definitely, that was great. Evan, Kelly, yes, the other night when you explained it with deer, it was clear. But then I was explaining also at the money, out of the money. You could formulate the deduction, but now I'm explicitly putting it out there, saying, look what happens. Like, you lose all your money, no matter how much you bet. If you get 100 calls, if you get 20 calls, if you get one call, if it's way out of the money, it's the same risk. Isn't that stupid? Like, think about that. Like, no matter how much you bet, like, let's say you were a stupid hedge fund manager, like, or maybe you just had buddies and they're like, hey, why don't you trade it for me? You do the stock market, right? And they give you their money, right? And you're like, oh, okay, I just got, $10,000 from all my friends. I'm gonna get the out of the money, whatever. I'm gonna get 1,000 of them because I got so much money from all my friends. You haven't increased any odds of success at all. And in fact, your odds of failure are exactly the same. No matter how much money you put on that trade, your probability of beating that strike, very bad, very bad, very difficult. Somebody says, that was a fantastic explanation. Thanks, Alex. Sergio, what if your in the money call expires out of the money? Then you lose all your money. But that's very rare. That would require, you have to look at that bottom line here, this bottom white line that I drew. That would require for the price of the stock to go all the way down to the bottom by expiration. Okay. And if it was going to do that, you can just set yourself up some kind of a little stop loss situation. Hey, if this thing goes down 20%, if it goes down 30%, I'm going to show you that on Thursday in the VIP class. I'm going to show you how you can get out of your trades at logical points. They're usually pivot points on the chart. But you would get out at the logical pivot point. It could be really nearby. It could be very nearby. Like right now we have calls on deer. We have a fairly nearby out for deer. We're not going to lose everything. Okay, so does that you understand? Yeah. But like if you're out of the money, they turn into lottos, because by the time it pulls away from you a little bit, it goes way down in value really fast. Like your $1,000 will become like $160 really fast if you have just like 2 days against your direction. Whereas if you have the in the money and you get like 2 days against your direction, you might only lose like 8%, 15%. It's really not a lot. But in the other, out of the money, you might lose like 85% of the value of your option already. Continuing on with the comments here, Joseph says, definitely clear, excellent. Camille asks, so can you explain how you would apply this for puts? That's an excellent segue. Really good job, Camille. And then Miguel says, it's so clear now, thanks. Let me just double check on this. The worst thing that happened to me early on when I started trading options was I printed huge money with a way out of the money option. And I thought that was a realistic trading style. And that was one hell of an expensive lesson to be chasing. Yeah, man. Yeah. And we've all done that. I remember, I'm like shooting back in my mind. I'm remembering days when I was, figuring out every earnings release. And like, because I nailed Facebook and, made like a 2,900% return on like a big bet. And I was like, oh, this is awesome. But by the way, if that's you, if that's what you're thinking, anybody, and that's you, and you've got the notebook and you're trying to do the earnings releases, stop now. Do not do that. Earnings release plays are absolute losers. You cannot win. It's because it's worse than a coin flip. It's not 50% like you might think. And then better if you have like earnings whisper and some good rumors and this or that. It's 25% at best. You have a 1 in 4 chance at best of being right, and that's just not enough. Anything less than a coin flip in life is a losing bet. Anything less than a coin flip is a losing bet. You have to have that right chance for it going in that direction. So we were going to talk about what do you do? How in this situation with puts? How would you apply puts in this situation? By the way, everybody, while I have everyone here on TikTok, make sure you click the link in my bio, because tomorrow we're going to do all day live day trading. It's going to be awesome. And we're going to do the coin IPO, and we'll be doing high frequency trading and day swinging. And we'll get into a couple of things that might be good for swings as well. All day long tomorrow for free in my Discord. Please click the link in my bio. Should be a really awesome day for you to just hang out with us all as a group. We have 300 slots in our Zoom for everyone to join in, and we'll all be together trading. It's going to be a lot of fun tomorrow. Go ahead and click through now. In fact, you can come and join this Zoom that we're in right now that you're watching on TikTok. You can come in and join right now with us. So let's do the converse on SPY, because that's what Camille asked for. How would you apply this to puts? And it's exactly the converse. It's exactly the inverse. It's exactly the flip. Okay. So I will use red. We'll use red for out of the money puts, and I will use green for in the money puts. Okay. Again, let's say you get the strike May 1st, which doesn't exist. Well, it probably does exist on SPY actually. But you get May 1st SPY puts, May 1st expiration. But this is just for illustration purposes. You wouldn't necessarily pick May 1st, okay? But this is going to help you figure this out. And in this case, green being good, green is going to be in the money options. So let's say you got 432 options. The 432, that's really deep in the money, but let's just say you did, because for illustration purposes, this will make more sense. 432 puts. It means from today until expiration, your in the money puts break even line, not break even, but to lose all of your money is this line right here. Okay. Now we're going to say red out of the money, red for out of the money. Let's say you choose 396 for whatever reason. Okay. Maybe that's not the most logical thing. Maybe 400 is, but 396, this becomes the line to beat. Okay. So now the trading starts happening and it starts going up. I'm going to use just red. Okay, I'll make the market color, the price of the stock, orange. Weird, but true. All right, so the future projection on this is going to be orange. So it goes up. The guy with the out of the money puts is freaking out because it went against him already. The guy with the in the money, he's only losing a little bit of money so far. Then all of a sudden we have that incredible day. Things start going way down. This could be probably what happens in the market. This is realistic, let's say, and we have like this terrible one day here, right? And again, price ends up just before the strike of the out of the money. So now where do the two guys sit? Well, obviously the guy that got out of the money puts lost everything, 100% total loss. And the mean reversion on SPY happened. Like everything that I said happened. Like when we were just analyzing SPY, that happened. Like in this scenario, we're forecasting the future. It happened. It came to fruition. And yet the guy that bought the out of the money puts, and you can see it here on the graph, it even looks realistic, wouldn't you say? And yet the guy that bought the out of the money puts is screwed. He lost everything. In fact, he never had a day, not a single day, where he was up on his money. It sucks. But the other guy, on the other hand, he was up on his money every day that was above when he bought it, basically. Every day that was above this line right here, the entrance line, for the guy that bought the in the money. Are we not drawing it? Oh. Every day above this line was green for this guy. So like all of this area here, this was profit for in the money dude. Out of the money dude was losing money, but in the money dude was making money because he was in the money, and he preserved all of his capital also, which was, you know, maybe, I don't know, it could have been like $1,000, $1,500, $500, whatever it was. Alex says, I lost like Camille, just real quick. Did that help explain it? Do you think you got it there? Awesome. Okay. It's just the opposite, you know, it's just the opposite. Okay. And then Swing on the Spiral says the only upside of out of the money calls and puts I see is the fact that you can get a lot more contracts for the same amount, and you can therefore take profits along the way. Yeah. Bad thinking though, because as you can see along the way, you're losing money every day, because this is really a theta line. I mean, this is what we explained. You might have missed the class that I taught, might have been yesterday or might have been a week ago or something, where we talked about options at the money, out of the money, in the money. And, you know, this break-even line is also kind of your theta, your time decay line. And you're racing against that. You could be up one day, the price of the stock goes up even further the next day, and you're at the same profit as you were yesterday, because you set yourself up with a high bar to surpass in performance every day. And if it doesn't surpass that, you don't get any increase in value. So that's what happens with out of the money options. Let's see. And then Alex says, yeah, dudes, you should check out the class. It's like literally over in Masterclass Archives. They're like 5 back. And it's listed quite clearly, like options masterclass or something. And then Alex says, I lost like $4,000 a long time ago trying to trade calls and puts on earnings. I stopped doing that pretty quickly. Yeah, I lost a lot more than that, probably 25 grand doing options a long time ago. All right, let me have another little sip of my margarita here or whatever this is. Oh, so good. All right, we're not even going to deal with this guy. Technical analysis can't be a profitable strategy in efficient markets. Okay. Technical analysis is just the graphing of information. But there you go. You got your little 15 seconds of fame. Thank you very much. I'll read more of that. Awesome. Okay. So you guys, yeah, I'll see you tomorrow for live day trading. Make sure you go ahead and click the link in my bio right now to come join our group. This has been awesome. Let me just double check like really quick. There's no more further questions on the things that I went over today, which is the market, SPY, and the difference and risk levels and dangers of out of the money options versus in the money options. You might have the question, well, what about at the money options, right? Well, it's a compromise. I mean, it's just like halfway in between. You will be not quite as at risk as out of the money options. And you'll also not make as much money depending as your trade probability of success will be lower. So that might be a question you have for about at the money options. Is it par on par for the same amount of money? You know what I mean? You could say, hey, maybe instead of $1,000, I want to make the potential of making $1,000. I want to make $1,020 for $20, right? And so therefore I buy that out of the money option. And now very rarely, 1 out of 50 times, I will equal the winnings of that one guy who got the in the money option for $1,000. But the thing is, if you think about it, you're going to also lose that 49 out of 50 times. Okay, just because you won it that one time doesn't mean the other 49 times you will lose it because of the probabilities that you're putting yourself up against. But the in the money dude, he's going to be able to manage his capital, keep most of his capital, and make capital like 95% of the time. You know, he's going to be able to control all of that. Very, very, I mean, it's basically never going to happen, but I'm not going to say never, but it's about 1% of the time will that option ever go so far low that, you know, he's only got like $50 left out of the 1,000. That would be just bad professional trade management. All right, guys, cool. Have a good night. And make sure you click the link in my bio. I'll see you tomorrow morning, everybody, for live day trading all day. It's going to be really fun. It's going to start 30 minutes before the open. So I'll catch up with you then. And I look forward to it. Should be hot. Should be awesome. We're going to do that coin IPO, which is going to be really great. Good night, everybody. Have a good one. In the money, 0.7 minus point. What are you doing? Good night. Good night, Kelly. Out of the money delta. Yeah, the deltas. That's the other thing, the deltas. Yeah, that's the one that, so everybody go watch that masterclass. If you're in the VIP, go watch that in the master.